Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. Giving you the sincere and actionable ideas that you need to be successful is what we're all about. 833-964-PLAN. That's 833-964-PLAN. Jump out to our website, getretiredstayretired.com. So it's still early in the game in 2026. There's plenty of time to go. And as you set your sights, let's talk a little bit about some money targets. David, I think when people are in the first quarter of the year, that gives them ample room to set goals, make them measurable, make them achievable, and work towards execution. And I think something that I see you talking with so many families about in the conference room through the platform of technology is making sure that you are helping people set goals that are measurable and realistic so they can improve the lives of themselves and their loved ones financially. David, talk a little bit about the process you lead clients through, looking at those midterm and long-term financial goals, which are unique to everyone. Some are saving for college, some are saving for retirement, some are just trying to get to a point that they can slow down and work. For others, it's vacation property. How do you work that goal-setting process, and how do we execute such at VestGen Wealth Partners?
Well, I like to start with the end in mind, right? So where do we ultimately need to land, and what are the steps that we're going to take over the next several years to get there? And a big part of goal setting, I think now is what were the goals that you perhaps wrote down 3, 4, 5 years ago, and how do we need to update those to get with the times now that we're in 2026? So specifically in relation to retirement planning, how is your planning around healthcare changed, right? Are you going to be getting subsidies if you decide to retire prior to 65? Maybe not. What do those bills look like on a monthly basis? My hunch is they're probably a lot more expensive than they were several years ago. So we've got to put that on paper. But I think financial planning is never about dealing in absolutes. You can never change things overnight. So the way I explain it to people is we've got to kind of figure out what small steps we're going to take each year to gradually get towards these goals, because financial planning is small improvements at the margin strung together over time. And how do we do that? I think, it comes in two parts. For me, it comes with you want to embrace technology because it's really good. And then we also have to do some whiteboarding. So with the technology, Craig, I kind of call that the stress test, right? And that's what a lot of people are used to. There's not a ton of different programs that people can use. I think the key is keeping that up to date. Maybe you can explain how we do that, and I'll talk about the good old-fashioned whiteboarding.
Yeah, absolutely. Listen, as we talk about setting your aim on various financial targets for 2026 so you too can achieve your goals and aspirations, it begins with what David said, that clarity of vision. It begins with that clarity of vision, that opportunity to say what's important to me and my family about money today, and then creating disciplined, robust steps to get there. That being said, it is ultimately a math problem. So many things in finance are a math problem. And we're here to help you, not just with the intellectual quotient, but we're here to help you with the implementation quotient. And part of that implementation quotient is financial planning comes in two broad-based forms, and you can't ignore one because they go hand in hand. You need to start your retirement modeling with goals-based planning. That's traditional goals-based planning, and make sure that goals-based planning includes simulations relative to changes in inflation, simulations relative to changes in underlying price conditions like healthcare. As David said a minute ago, you should be assigning a different inflation rate to your healthcare expenses than you are your core living expenses. And then this other simulations are about how income taxes are going to change, and what you're working towards is a coefficient confidence index level. It's a fancy jargon way of saying how confident are we through goals-based planning that you're going to achieve your goals. But there's a whole other part. The other part is cash flow modeling. See, in the real world, you can have the greatest plans on paper, but it's all about cash flow. Retirement is about income. Retirement is not about assets. And at VestGen Wealth Partners, we use a very robust cash flow modeling system to help increase the efficacy of people's returns through retirement, because you want that systematic, consistent cash flow that you can count on, so you too can worry less, which allows you to live more. So David, I think a big part of this, as we talk about the goal planning, and that's what we're discussing right now, is making sure that your plans are doable, they're specific, they're measurable, they're achievable. But I think people also need to be investing in themselves, David. So talk a little bit about what it means to invest in oneself.
Well, for me, investing in yourself means to actually take a step back and say, what do I want this to actually look like? A lot of times families come to us at what I call an inflection point in their life. That could be a job change. Oftentimes it's, hey, my kids are finally out of college. They're off on their own. This is going to be our time. And if it's going to be our time, now is the time where we're going to spend some time at the dining room table, and we're really going to go through and map this out of what we want it to look like. Then we're going to take that and we're going to stress test it, as you said, Craig. And once we have that stress test, well, then our job is to show how we actually implement. And the implementation is that whiteboarding we're talking about, which is, what's the liquidation order of accounts? Right? Which accounts am I withdrawing from first, second, third? Based off that, how are we going to invest that capital? Because the investment allocations might change now that we're deconstructing the portfolio. And you have to internalize that we're not going to be adding to these accounts anymore. We're going to be taking money out. And that comes with different emotions. And we have to spend time kind of going through. Part of our job is to challenge people to say, like, are you comfortable if this happens when you're in this new phase in your life? And I think that's part of the price that everybody pays to retire.
And that's exactly what I meant by investing in oneself. Most people are coming and they're getting serious about their retirement plan because it's their time. The kids are out. The kids are grown up. It's your time. Maybe that sounds selfish saying it's my time again, but it is. It can be the best times of your life. You're still working. You're making money. You've got cash flow, but you need to make sure you're paying yourself first. And David just alluded to it. I'm going to jump on it as we talk about some of these goal plannings for 2026, some of the things you need to be thinking about. You always need to have preparedness and flexibility. I repeat, preparedness and flexibility in the retirement planning process. And that means preparing for unexpected expenses. Expect that things can and will go wrong. And that's why you need to do that goals-based modeling. That's why you need to do that cash flow-based modeling, because you need to identify your blind spots. Something I talk about all the time at VestGen Wealth Partners is our job is to help you future-proof from all the problems that can and oftentimes do come up, such as not being able to work as long as you intended, having to care for an aging parent, having to deal with the fact that the adult kids might need to come back to borrow if they get into financial trouble. And how do you do all those things without disrupting your well-laid plans? Well, you know what? That's just a part of the planning process. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And David, that brings me to number 4 when we talk about 2026. There's plenty of time left in the year. As you set these various money targets, you've referred to it, David, on multiple occasions as building a solid team. Talk about what it means to surround yourself with accountability partners and true partners working towards your goals.
Yeah, I think most families know what they need to do, but sometimes life gets in the way. And for the right families at the right point in their life, I think one of the reasons a lot of folks are drawn to VestGen is it's a single hub to go to. It's a single hub to go to design investment strategies, to design estate plans, and to discuss tax strategy. Do we need to be your CPA? No, but since we do taxes here, we know our way in and out of a 1040. Do we need to be your estate planning attorney? No, you may have already done your wills, trusts 5 or 6 years ago. We don't need to throw those in the shredder. But if you're ready to have conversations that go deeper than just a pie chart of investments, we are the team that gets that done. And I think what people appreciate is the opportunity to sit down with multiple professionals at one table to whiteboard out what all of this stuff is going to look like. And that's what we provide here.
Absolutely. We don't just provide it, we provide it well. So I want to connect you with an enduring theme here, which is inflation and retirement. Inflation remains the silent killer of everyone's retirement plan. So please go out to our website, getretiredstayretired.com. Download for free today our inflation and retirement publication. It's what you need to know, how you can be prepared, and then stay tuned. Hey, grandparents out there, there's a new loophole for college savings. If you've got grandkids that you love and they love you back, you need to know about this. And for everybody, if you've got a son, daughter, nephew, niece, whomever it might be, we're only a couple short months away from Trump accounts and free money. We'll talk about what that means when we come back.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Hey, it's still a new year, and with new years come new regulations. And when I think about the gateway of how people pay for college, a lot of it has to do with savings, but a lot of it has to do with that free application for federal student aid. And the FAFSA rules are different for 26 and 27 now that we're using something called the Streamlined FAFSA. That being said, is there now a grandparent loophole to maximize college savings? You bet there are, but I couldn't think of any better way to talk about college savings than to bring in David. David, it was a great comment in the previous segment as we talked about these 4 waypoints, goal setting, things you need for 2026. But people of all ages know that education leads to empowerment, right? Education leads to empowerment. And David, talk about why we don't want to be saving for college directly in these UTMA, UGMA accounts.
Yeah, I think there's a couple reasons, actually. I mean, that used to be the way that most people do it. So even grandma and grandpa want to help out their grandson, and they might want to buy, 50 shares of Disney stock, and they open up this UGMA account. But I think there's 2 general reasons. One thing that I think catches some people off guard is once that child reaches the age of majority, it becomes their money. And in certain cases, whoever the custodian is, whether that's mom or dad, grandma and grandpa, perhaps they're okay with the child receiving that money. But I've seen plenty of circumstances where accounts were opened 20 years ago, and they get a letter from the company that's sponsoring that UGMA, and it says, hey, we are going to force the money into the child's name. It's now the child's money. And then grandma and grandpa says, well, wait a minute, that money was earmarked for school. I don't necessarily want them to use that money for whatever they want. So I think number 1 is, are we going to be making an irrevocable gift to that child? Because the reality is it's their money once they hit the age of majority, and perhaps that's not the intended outcome you're looking for. Number 2 is, go ahead, Craig.
And keep in mind, the age of majority is different in some states, guys. In some states, it's 21. In other states, it's 18. You don't want your high school graduating senior getting access to their money at the age of 18 to go on spring break. So I think there's limitations if you're saving for that next generation as to why you wouldn't want to use UGMAs, UTMAs. There's other options, especially if we're talking about college. David, what was next on your thought?
I think the next reason is generally speaking, we like to keep the money out of the child's social security number if possible. So we want to keep that money in the adult's social security number. So that's why, you've seen more people kind of leaning towards like 529 savings plans. Those are accounts where they're owned by an adult. The child is the beneficiary of the account and the adult maintains control. And I think depending on who's funding that account, one of the other benefits is you don't have to provide full disclosure. So if grandma and grandpa are funding an account for their grandchildren, they don't necessarily have to tell everybody or even mom and dad how much money they're putting away. If they decide to change their mind or move money between beneficiary accounts, they can do so at will. So just a lot more flexibility in that standpoint on top of the additional tax benefits that some states provide.
So we're talking about that conundrum that is saving for college, and we're tying it into new year, new regulation, the way the new Streamlined FAFSA, free application for federal student aid, works, and the grandparent loophole it's created. More on that in a minute. So here's the bottom line. If you're thinking about saving for college because you're excited, you've just been blessed with grandchildren, I encourage you to pause before you simply open up that UGMA, UTMA. I encourage you to pause before you go down the road of opening up what I call an educational savings account. That's a Coverdale account. I think you need to embrace and learn all things that are 529 college savings plans. They come in two varieties. Those are prepaid tuition plans, and then there are savings plans. Think of them kind of like pension plan versus 401k plan. And in today's environment, I think preparedness and flexibility remain paramount. And for that reason, many people are better off using 529 saving plans versus 529 prepaid tuition plans.
The other thing I want to mention there is, we talked about goal setting in our last segment. If you have 5 minutes, do yourself a favor, or do your kids a favor, do your grandkids a favor. Spend some time on a college savings website, get a pen, and just take a look at 3 different schools, perhaps one state school that might be close to you, one out-of-state school, one private institution, and write down what those costs look like. Because I think one of the things that I've seen over the last several years is people are saving based off benchmarks that might be inaccurate. They might say, hey, I saw online average college cost per year is X. But then when they compare that to perhaps an SEC school that's out of state, their savings plan doesn't represent what that state school actually looks like. Even in Illinois here, as people go to Big Ten schools, right? There's a dramatic difference between some of these big schools, and we're talking 2x the cost. So it doesn't take a lot of time. All of these costs are fully integrated into most of these college savings websites. But I think it's good, as we're talking about goal setting, to make sure that our goals are accurate and properly reflect the costs that are going to be out there for a 4-year education.
David, I think that's right. You just have to create awareness, get everybody involved, have money conversations. It's good. So I teased everybody. What is this grandparent loophole when it comes to college savings and 529s? Number one, grandma, grandpa, you might live in a state. Illinois is one of them. I want you to get a $20,000 deduction on your Illinois return. Yes, you too can get a deduction on your Illinois return. But the grandparent loophole is this. For the longest of time, you have to understand that when it came to financial aid, which, by the way, is a big part of college for so many people because the prices have run away, is previously no longer distributions from a grandparent's 529 plan. While they're not taxable, they're tax-free distributions, they were treated during that FAFSA application process as student income. And you know what that would do? It would reduce the amount of student aid eligibility that somebody could get. But the good news is now that we're under this new streamlined FAFSA that's taken place, you don't have to worry about that. Why? Because students who are applying for financial aid no longer are required to report gifts from a grandparent. They're no longer required to report distributions from grandparent-owned 529 savings plans. So grandma, grandpa, my comment is you can give freely and you can integrate into your grandchild's college experience much easier without disrupting the FAFSA process, the free application for federal student aid. And that's great news. So I want you to learn how to maximize your estate and gift tax legacy. I want you to learn about how to create this indelible mark on those family members that you love and they love you back by messaging with some help for college. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. David, you know what else is exciting? Trump accounts. Trump accounts are super exciting. Why are Trump accounts super exciting? You're probably saying, what is a Trump account? Well, listen, guys, the One Big Beautiful Bill Act created these new tax advantage savings and investment accounts for kids. And of course, they're nicknamed something. They're nicknamed Trump accounts. And you can almost think of a Trump account as a cross. It's like a hybrid. It's like an individual retirement account and a 529 savings plan got married and combined. And what this allows people to do is put away up to $5,000 per year until that minor reaches the age of 18. And all of those dollars that you're putting away, they're going to be growing on a tax deferred status. Even better, did you know that people are going to get free money in their Trump accounts? Oh, yes, they are. If you've got a newborn in that family, someone being born 25, 26, 27, 28, they're going to be eligible for a free $1,000 grant. That's a $1,000 head start, but no one's going to get that $1,000 unless they open the Trump account and get the free money. In addition to that, maybe your kids our grandkids are already here. Well, don't worry. Rumor is there's going to be a $250 tax credit coming to many of those children. You too should want to claim that free money. And David, I don't even want to tease people, but if people found a way, seriously, if people just found a way and they thought about the potential growth in this, if you could fund $5,000 per year each year for 18 years into a Trump account and assume a reasonable growth rate, I'm not talking double digits, I'm talking just 6%. By the age of 18, that would turn into $191,000. Yep. That's not a small amount of money. And if you let that money just incubate in that Trump account, because you funded it every year for 18 years, by the time that child reached the age of 60, it could be worth $2.2 million at just a 6% rate of return. David, are you getting Bennett and Reagan Trump accounts?
You know it.
I'm helping my niece and nephew get Trump accounts. Everybody wants a Trump account. Let me help you get yours. 833-964-PLAN. That's 833-964-PLAN. GetRetiredStayRetired.com. GetRetiredStayRetired.com. More to come. Craig and David in the know. AM 560, The Answer.
You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
So we've talked that there's lots of time left in 2026. That's why today we're talking about goal setting. We're talking about the grandparent loophole to empower education. We're talking about Trump accounts, but all of it does come down to something. You need to be investing, and you need to be investing better. And when I talk about investing better, we continue to believe that in 2026, you need to stay active amid all of the complexity. I mean, there's easing cycles that I think are still in place. Artificial intelligence arms race is still here. There's deal making. And the bottom line is people need to be relentless and focus on strategically positioning portfolios to seek returns. David, as we talk about that, remaining relentlessly focused on strategically positioning portfolios to seek returns, how are you helping people do that conceptually in 2026? And then we'll break it down into some investment themes. But what does it mean to you, aligning investments with a plan?
Well, I don't think there's a one size fits all with investments, but I'm always clear with people that, we don't subscribe to some of these economic forecasts or having price targets on the S&P 500, because the reality is every year the Wall Street Journal publishes a list of the top 50 economists, and more than 80% of them are always off by a significant amount. And what that means to me as an investor then is a portion of your money is always going to be strategic and long in the market. You have to participate in the market long term to get that compounding effect. And typically what that means is we want to have some very low cost strategies that are always involved and invested. Part two of that, though, is I think we're entering an environment where having a little bit more activity is going to make sense. There's clearly lots of things out there that are shifting market sentiment. Part of that could be valuations. Part of that could be policy. So I think we're entering this time period where investors do need to think a little bit differently. Now, that doesn't mean that they have to allocate a gigantic portion of their portfolio to investments that they don't understand. But I do think that this means that investors need to rotate and take some profits on things that may have done very well and rotate those proceeds into other asset classes that might be trading at better valuations. And then part three, I would say, is probably getting some real diversification, things that are not publicly traded, perhaps things, that AI can't replace or can't reprice. So Craig, for part two, talk a little bit about what active means to us, because active to me doesn't mean that you have a crystal ball.
No, active doesn't mean you have a crystal ball. Active doesn't mean your market timing, but I think active means you're going to be navigating the nuances across these public markets. And when I say, navigating the nuances across the public markets, that means you've got to see potential for greater equity market dispersion. The returns aren't just going to come from the place the returns came from the last 3 years, the Magnificent Seven. I think you need to really favor an active global equity diversification. What do I mean by that? You got to be getting dollars onto the other side of the pond. You absolutely do. And in addition to that, we're going to talk in a little bit about how to do fixed income, how to do your bonds better by being focused on diversifying your duration, positioning in the correct spot on the yield curve, and you got to have some level of good security selection using not one, not two, but 4 distinct areas of the bond market. So David, I think this is the year that the diversified portfolio really does in fact shine, because there's going to be enough dispersion of returns happening. And for that reason, I want to remind everybody that de-dollarization is still a thing. Let me say that again. De-dollarization is still a thing. There are lots of other countries that are out there that they don't like us. And if you're honest, you might not like them either. The reality is this. Countries every single month are continuing to store their assets in U.S. denominated things like the U.S. dollar, U.S. treasuries, U.S. investments. Why? Our economy is fantastic. Have you seen the GDP reports lately? But countries also know that they no longer want to be as dollar denominated. That's the reason you're seeing this consistent bid on gold, on silver, on other currencies. And as a result, everybody, if you're in a stage where the dollar continues to weaken, that is going to magnify for U.S. investors foreign or international stock profits. So guys, get off just the S&P 500 and make sure you're embracing S&P Global. Part number 2 of that, David, I just want to talk about this. I mentioned diversifying the duration. Everybody, people still think they're getting 5% in a money market. You're not. I think people think they're still getting 4% in a money market. You might be, but not for long. Most of them are in the 3s. Don't fool yourself. You should have already been locking in yields. You need to use barbell, ladder, and bullet strategies and create permanence and definition in your portfolio. David, talk about why people shouldn't just be in the aggregate bond index fund. My gosh, what's the return on that for the last 5 years? Negative 0.3% each year for 5 years. Talk about how we solve for diversified duration at VestGen Wealth Partners.
Yeah, it's getting back to basics. So for a while, we've talked about this concept of going back and creating wealth the old-fashioned way. And when we were talking about creating retirement cash flow strategies, this is exactly what we're talking about. So if we know that we're going to be retiring in, say, 2028, well, what we're trying to do today is I'm trying to lock in the cash flow that we're going to need for the first 3 to 5 years of retirement. And one of the ways that we can do that is we buy individual bonds today because we know exactly where the interest rates are, and we lock in those rates, and we're just staggering the maturities so that every several months, you, the client, know exactly where you're going to get your money from. And by buying them today, again, we're locking that in, because what we're concerned about is if you're just buying a money market account, hey, it might say 3.5% today, but what's the yield going to be in 2028 or 2029? Could be significantly lower. So part of that those are still shorter term bonds. Part of that is let's lock that in so that there's transparency so you can see where you're going to get your money from. The other part of that is the longer term planning, where we might want to go out even longer than that, lock in some set yields just to generate additional income. And the difference between buying a mutual fund and buying some individual bonds is that you get to pick and you get to control what that duration or interest rate sensitivity looks like, what those maturity dates look like, and how much yield you want to pick up. And the reason we're able to do that at VestGen is because we have such a robust team behind the scenes.
David, I think that's so important. So you guys feel it. You know it. You listen to AM radio because you're an information junkie like we are. And that means you know that the shifting paradigms for portfolio construction are here. The investment landscape literally demands a fresh perspective on how portfolios are constructed. The landscape demands a fresh perspective, not just on how portfolios are constructed, but the way they're managed. And I think you got to recalibrate. You got to recalibrate, not just with public markets. You got to recalibrate and embrace some level of private markets. And I want to highlight what some of those areas are for you and your loved ones. But we're going to pay some bills first. That means go to a commercial break. All right. In the meantime, I want you to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. You know that inflation is still a problem for everybody. I want you to download our inflation and retirement publication for free. That's inflation and retirement publication for free at getretiredstayretired.com, because you need to know what to know. More importantly, you need to know how to prepare. And when we come back, we're going to talk exactly about what I just teased, which is that you need to have a shifting paradigm, a renewed focus on how portfolios are constructed and managed. You're listening to Craig and David Bolanos, VestGen Wealth Partners, in the know, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
You know it to be true, and we're here to fulfill it. The investment landscape absolutely demands fresh perspective on how portfolios aren't just constructed, but how they're managed. I think you got to recalibrate if you want to enhance and continue to generate your returns. And what I think about right now is there's a number of things, trends that are going to continue to grow in 2026. Some of those trends are active ETFs, both on the fixed income space and the private asset space that are driving public access. In addition to that, I think we might stand on the precipice where finally, after, it feels like so many years, did you know that real estate might just be ready for a rebound? I mean, David, it's been not one, not two, but 3 years of muted transaction activity. And I think real estate could finally be ready for that rebound. I mean, cap rates rose, marginally in 23 and 24 along higher rates, but they really leveled off in 25. And if you think with the start of rate cuts across many markets, expectations for more rate cuts, rent growth, which is finally starting to decelerate, but with so much money leaving that asset class, it's got to make you wonder, is real estate ready for a rebound? David, talk about how you work with clients at VestGen Wealth Partners relative to real estate.
Well, let's define real estate first, because to me, there's two general ways we can play that. We can buy real estate stocks, or we can buy private real estate, which I think we kind of view as the hard asset. In my personal preference is if we're looking to build real diversification and additional income, that we buy the private real estate, the hard asset, versus the publicly traded stock. And my simple reason for doing that is if we're trying to create better risk-adjusted returns, AKA perhaps some lower volatility, then the next time the market goes down significantly, I'm of the view that most stocks kind of move in lockstep, meaning if the whole market goes down, real estate stocks are going to go down. But the private real estate, right, tends to weather the storm a little bit better. And so to your point, Craig, we know real estate struggled 23 and 24 due to these massive spikes in interest rates. Now the opposite is occurring. We're already several percentage points off what looks to be a bottoming market. So the entry point today looks very appealing. But I think the other thing to think about is this isn't real estate of 10 and 20 years ago. So when we're talking about real estate today, we're talking about the hard assets that we need, right? Industrial warehousing. Are people going to keep ordering things online? Those massive distribution centers you see when you're driving down the highway, the data centers to power all of this AI. That's what we're talking about when we think of real estate today. It's not always strip malls and stuff like that anchored by a grocery store. That was real estate of the past.
Absolutely, David. So I think you need to critically challenge yourself and need to understand that alternative investments are not meant to be scary. I would argue that the private market landscape has undergone a significant transformation over the last 15 years. And what we consistently see is amongst high net worth investors who tend to be at the forefront of these changes, making an allocation not just to public markets, those that trade daily, but to private markets by partnering with solutions that are common sense on the real estate side, the infrastructure side, the lending side. It's kind of where you want to be. I would argue where you need to be at this point in the market cycle, given the asymmetrical risk premium that's in stocks. If you want to learn more, you absolutely can. And we're going to keep talking about it right here. 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. Getretiredstayretired.com. I mean, David, all of these are around these evolving thematics. You know, I still call them these mega trend themes. And you mentioned one, which is infrastructure. I mean, America, listen, that infrastructure asset class It's going to continue to require significant, and I mean significant capital for essential service projects, because we're talking about artificial intelligence, the energy transition, and the circular economic efficiency that comes with both. And governments and corporations are getting together through public-private market partnerships to go ahead and build out these resources or refurbish the existing resources that are out there. And I think, again, infrastructure's got to be a place. And I don't know about you, everything comes online. Everything comes online. And tariffs have changed the game. The biggest retail stocks keep getting bigger. The smaller guys are struggling. And what we're going to continue to see is this large move towards omni-channel, where the biggest companies in America, retailers, think companies like Walmart, are going to just continue to increase their retail footprint through their online experience, meaning order online and get it as fast as you used to at Amazon, but have the ability to just return the product if need be at your local store. And maybe that's the reason you continue to see all these industrial warehouses build up. And you know what's crazy, guys? If you look at the newest ones, they don't even put the heating, ventilation, and air conditioning on the roof anymore. Why? Because they're saving that for the mini helipads, because the drones are coming. If you didn't know the drones are coming, the drones are already here for delivery. That's a part of this story. And all of it, of course, is powered by what? All of it is powered by AI. David's talked all of last year about getting involved in data centers, either as an owner or a lender, combined with cell towers and fiber optic networks. And I think you shouldn't miss it. But David, the other piece I want you to talk about is just the traditional private equity piece, because over the last 15, 20 years, the number of public investment opportunities continues to shrink. All of the companies stay private, and no one's ever going to have a chance to see any of these private companies unless they participate in some form of private equity. So how are you getting clients coached up to maybe start putting their foot into the doors of primaries, secondaries, et cetera?
You're exactly right. I mean, we aren't seeing the same amount of IPOs, initial public offerings, that we have historically seen. Companies are staying private longer because they're getting capital from these private equity firms. A lot of that is in the technology space. And if you want to participate in some of these large companies, the only way to participate is through private equity offerings. So I think when I set the stage with families of why we might want to dip our toes into this asset class, the first thing is setting expectation. These are not get rich quick things. These are just alternatives to publicly traded markets. They are designed, from my standpoint, to aid in risk adjusted returns, and they allow you to access different asset classes that you can't get through just a basic ETF. And let's also talk about the tax benefits. I think this is huge, is when we're talking about infrastructure investments and other hard assets like real estate, a big portion of the return driver is the income that you receive, the dividend income. And the really interesting part about that is for investors that are investing non-qualified money, a significant portion of that income comes through as what we call a return of capital. And here's all you need to know about return of capital. In a lot of cases, means those dividends are extremely tax efficient. The whole dividend's not taxed. Once we add that on, that's a great example of improvements at the margin to help retirement monthly income.
Absolutely. And if you want to learn more, you can. You absolutely should. Connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. You know the number by now. It's 833-964-PLAN. That's 833-964-PLAN, because you feel it. You know it. You're on the pulse. We're in the trenches. We're here to help you with the intellectual quotient and the implementation quotient, because the investment landscape demands a fresh perspective, not just on how portfolios are constructed, but on how they're managed. So let's recalibrate and make 2026 great. You're talking to Craig and David in the know, VestGen Wealth Partners on AM 560. The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
We've got lots of time left in 2026, and that means you too can still level up your wealth. And part of leveling up your wealth is about the goal setting, having an accountability partner who can be with you to not just set goals, but to understand why those goals are powerful and purposeful and really represent you and yours. That's aligning what I call your money with your attitude. That's aligning life with your wealth. And then you have to be thinking beyond that. And after it's the goal setting, you got to have the tools, you got to have the goals-based modeling. You got to have the cash flow simulations. You got to have all of the stress tests built in because you too need to future-proof. A big part of what we do at VestGen Wealth Partners is future-proof. And then David said it's winning at the margins, and winning at the margins means not just you, but the generation above, the generations below. If everyone's doing well, then you too do well. And then why not use things like the grandparent loophole for 529, courtesy of the Streamlined FAFSA? Why not use the Trump accounts that are getting released in just a couple of months to build wealth, to create what could be upwards of millions of dollars by the age of 60 for a minor child, just because you have the ability to save in a tax-sheltered environment from day one? That's huge news. And again, the investment world is evolving. What are you doing to evolve with it? Because you need to have this diversified, multi-asset class global portfolio, because you know the returns are going to start experiencing a dispersion of returns, because the S&P 500 is clearly no longer the only game in town, given where asymmetrical risk premium is in market valuations. We exist here to help you do better. We exist so that you can worry less, live more, and enjoy everything you've worked your entire life for. So move away from the solo advisor model. Adapt a team. Adapt a family office for regular folks. If you want your cash flow modeling, your tax strategy, estate and legal, retiree healthcare, your investments under a fiduciary standard, you know where to turn. It's a phone call away. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Let's connect. Let's make 2026 great, because you too deserve to level up your game, and we stand ready to help you do such at VestGen Wealth Partners.